Hello, you beautiful Spark, and welcome back to another solo episode of Spark TV. Today, I wanted to share my experience raising capital with you. So if you don't know this, obviously you're tuning into Spark TV, so you may be familiar with our business, Spark Business, which is the platform for women in business who want to grow their profit and impact. But you may not know that this isn't my only business. So my other business, Scrunch, has been around for over 12 years now. It is an influencer marketing platform and social media agency. And that is very different to the Spark business model. So Scrunch is very much what you would call a startup, and we built a tech platform. We went out and raised capital, and it was grow at all costs, build team, zero profit, all of those good things. We really bought into the startup hype at the time. It was raise as much money as you can, have the big fancy office, have the team, do all the things, be featured in the startup news. And we definitely ticked all of those boxes. Fast forward, and now the business looks very different. I have been on a journey of self-discovery and have realized that I drank the startup Kool-Aid, and that's not the type of business that I want anymore. So it does look very different. And obviously COVID had a huge impact. We, signed a big warehouse lease in 2019 for 5 years. Oh my God. That's a story for another day. But what I wanted to reflect on was the capital raising journey. There are so many people in the Spark business community who are interested in funding for their business. And now, fast forward 12 years, there are so many different options for women in business. There's, bootstrapping, which has been around forever. There's crowdfunding. There is, those, like pre-sales, there's debt equity now. There's, so many interesting things, and grants, obviously. But back in the day when we started Scrunch, raising capital was the thing. So and look, don't get me wrong, we initially started the business. We did all of the good things that entrepreneurs do. And I took my house deposit and I used that to fund the early iteration of Scrunch, maxed out credit cards, personal loan debt. And then we moved into needing some kind of financing. So we worked with our friends and family. We worked with our professional contacts. And then we started raising capital from angel groups. So over a period of about, I want to say 6 years, we ended up raising $3 million in capital or equity for the business Scrunch. And I wanted to share some learnings. I'm going to give you 5 key learnings today because it's very glamorized. Raising capital is really glamorized. It's what you hear about in the media. The media headlines are X startup just raised $1 million to do XYZ. You don't hear about this startup is highly profitable and bootstrapping and giving it their all. You don't see headlines like that. It's the big dollar numbers that are really glamorized. And, now as a recovering tech startup founder, I reflect on that and I think that's so unhealthy. And I think that the landscape has changed a lot. And even investors now are really looking for highly profitable, highly scalable businesses. It is a different landscape. But these lessons that I'll share with you probably ring true no matter what time we're in. And the first one is that it's actually a sales process. So raising capital is very, very, very much a sales process. You need to know who are the pool of investors. So, who are your potential customers? You need to reach out to them. You need to reach out to them again in case you don't get in touch. You need to sometimes get referrals. You need to pitch them. You need to follow them up and you need to close them. That whole thing is a pipeline. And we absolutely managed that like a sales process every time. And if you don't even know where to start, there's actually some really good resources available now. If you Google angel lists or VC lists, Airtree in Australia has a really good one. I think they've basically mapped the landscape of high net worth individuals, angel investors, angel groups, VCs, all across Australia with their contact details. So actually accessing, that top of funnel pipeline is really easy. So yeah, my advice to anyone is if you're going out to raise capital, you've got to think about it like a sales process. And it's a full-time job, just like sales is a full-time job. You are going to probably be reaching out to hundreds, if not thousands, of potential investors. How many of them convert into a meeting? And then you're going to be in hundreds of meetings. I've pitched Scrunch hundreds of times. I've sat in hundreds of investor meetings, and we probably have, I want to say, 20, 30 people on our cap table for Scrunch. So yeah, so even though I started with the list of thousands, seriously, it's exactly like a sales process. It whittles down. Think about your conversion rates. So if you're thinking about raising capital, I would encourage you to think about it like it's a sales process. The next lesson I learnt quite difficultly is that it actually doesn't get easier from round to round. So when I first raised capital for Scrunch, I didn't know somebody who could lend me $100, let alone invest hundreds of thousands of dollars in my business. And at the time, the very first round, we actually worked with a broker and literally invested like our last dollars into this guy. And we were super fortunate. We got a few $100,000. It's when we first formed our first board and first advisory board, and it worked out quite well. Now, don't get me wrong, in the second round, sure, now that we had shareholders, a board, an advisory board, they were able to send us their contacts, introduce us to people, but it did not get any easier. Different things changed the next round. So the next round, it's all about, well, have you done what you said you were going to do with the last capital that you raised? And you're potentially looking for a larger amount of capital, so the types of people that you're raising from might be different, or if you're still going after smaller people, you need a lot more of them. So the next round actually got no easier. And look, I'm just telling you my personal experience. This may not be how it was for everybody, but I just like to tell it warts and all, because if you are about to embark on this process, I would hope somebody is honest with you. The third one is, it is all about relationships. And this probably goes back to it being a sales process anyway. However, it's a really weird one with investors. So this is the one that stumped me, right? So with sales, you can figure out how to change your pitch to convert people better. So when you pitch people, they will give you objections. They will talk to you in the language that they talk to you in. And over time, you get better and better and better and better and better at selling because you do it more. The thing that I found with investors that I could just never figure out how to optimize is you are just dealing with someone who's taking a gamble on you. So sure, you can optimize your pitch. You can, every investor meeting I had, I would write down all of their questions and I would get better and better and better at answering them. And let me tell you this, they all ask the same fucking questions. It's literally stupid. So just find those questions and get good answers and you'll have a really good pitch. However, most of them are just investing in you as a person. Or potentially in your industry, or just, this idea of scale, like the potential opportunity. So it's hard to get better at that. They may say no because they just don't vibe with you. They may say no because it's just the wrong time for them. And you can't optimize for that like you can in a sales process. So yeah, you do have to be really invested in building great relationships so that people do really get to know you. People do want to back you. People do refer you on to other investors. So yeah, really dedicating time to relationships before you even want to raise capital. And especially once you have raised capital, and keeping people on that journey is just so, so important. That now becomes your job as a founder, is to be constantly like hype girling your business to investors, especially if you plan to raise a future round, which most people do. Once you get into that cycle, it gets pretty difficult to get out. So lesson number 4, do what you said you were going to do. Now this, I have to tell you, is the number one thing that meant we raised multiple capital rounds. And that is because every round that we went to raise, we could say, we told you we were going to do this with that round, and we did it. And whether that was, all the way at the start, it was just getting to market. It was just getting the technology platform developed and getting to market and getting those first customers, which we did. So each time we went back to investors, we had delivered on what we said we were going to deliver on. And that was the biggest thing. It meant that by the time we would come to pitch, they would trust what we were pitching. They would trust our future looking pitch. They would trust what we planned to do for the future, because we'd done it every other time. So being really careful about what you promise and being really careful to deliver on that promise was a huge, huge lesson for me. And the last one, number 5, is one that I reflect on a lot now as a person who's, over a decade older and gone through all of the wars. Oh my God. And one I ask to founders who are talking about raising capital as well. And the question I pose is, do you really want to raise capital? Do you know what raising capital actually entails? So funny, I always had this funny vision in my mind. So the first business I ran was a blog. So I was a blogger and I sold advertising on my blog. And so it was kind of one of those businesses where it was the more effort I put in, the more money I made, and I could do whatever I wanted with that money. And I remember when Scrunch was doing really well, I had this thing in my mind. I was like, you know what, when we have a $100,000 month or whatever, I'm going to buy myself a handbag. I'm going to buy myself a nice handbag. It's going to be like a real milestone purchase. And then I quickly realized that money's not mine. I'm an employee now. I was an employee on a modest salary working for a board and shareholders. The business, once you raise capital, is no longer yours. You are beholden to what you said you were going to do. You're beholden to board meetings, to minutes, to admin, to shareholder updates, to explaining yourself if you change the strategy, to making sure that, yes, you are an employee of a business. Sure, you have the CEO and founder or co-founder title, depending on your situation, but you're an employee of that business now. And for some people, that's totally cool. I know there are people in the Spark community who are like empire builders, want to list on the stock exchange, have raised multi-millions in capital, and on that path. And I was on that path too, so I'm not shitting on that path. All I'm saying is I think in the media we romanticize that path, and that's where space is held for those headlines. Not so much space held for the lifestyle businesses or profitable businesses or, social enterprise businesses or anything like that. So I feel like some people think that's the path they have to go down. And the reality of what's involved in it once you are on that path really isn't articulated at all. I just remember getting to a stage in my business where I was like, wow, I'm miserable. And look, fortunately for myself, we could get out of that and we could structure the business in different ways, and we could move to, more virtual teams, less employees, all of those things. But that hasn't stopped there being reporting, boards, shareholders, all of those things. I am so fucking lucky. I literally have the best board and shareholders you could ask for as a founder. They have been so supportive. They have been so strategic. Through COVID, oh my God, like everyone was just, you know what, you do whatever the fuck you need to do to stay in business. I could not have asked for better board members and shareholders. Don't get me wrong. Over the years, there have been a couple of personalities. That's probably a whole other podcast episode when I have less PTSD. But On the whole, I've just been so blessed with the most amazing board and shareholders. However, it is a very distinct choice as to how you want to run your business and how you want to show up each day and how you are essentially, and you do essentially become an employee. So I always love to ask founders before they raise capital the first time is, do you really want to raise capital? So there you go. They're my lessons, food for thought, of raising $3 million in capital over the last 5 or 6 years. It is a sales process. It doesn't get easier. Build great relationships. Do what you said you were going to do, but also think about what it means to raise capital and whether that's the type of business that is going to suit you. If no one tells you today, you're amazing. Thanks for tuning in, and I will chat to you in the next episode.